Welcome to day 24. What is a cash flow statement? In this chapter, you will learn what a cash flow statement is, and you will also learn how to use cash flow statements to identify strong companies versus risky companies. So let's get started. If you remember in previous video, day 4, what is a share? We learned about income statements, balance sheets with a coffee shop business owned by owner John. One of the things that I had briefly mentioned was the existence of a cash flow statement, but I did not get into any details on how the cash flow statement was used and what its purpose. And so that's what this lesson is going to do is we are going to go back to the basic understanding of the income statement, balance sheet, and we are going into incorporate into that the cash flow statement. Before 1987, a cash flow statement is not even required. But in order to be more faithful as to be what's happening inside of the public traded company, cash flow statement is now required. Just a recap, the income statement which you will find on the bottom left here, what I'm going to use for this scenario is a basic coffee shop. We are going to say it's called John's Coffee Shop, and we are going to just use some generic money to show how that money flows through the coffee shop business, and we are going to show how each one of these three statements do. So the very first one that you have to understand is the income statement, and you should be basically familiar with this. And the income statement demonstrates the amount of money being generated from the operating activities of the business. So this report will show you how much money is flowing into or out of the company based off of that product. This would be the sale of John's coffee. So let's say that John sells enough coffees to generate enough income of $100. His net income would be $100, so that the $100 would be reported off of that income statement. At the top of the income statement is going to be revenues, and at the bottom is going to be the net income or the profit. Okay, so that $100 of profit flows into John's coffee shop. That's the profit that he made, and so that income statement would capture that. Now once that money is inside John's coffee shop, before we were showing how that money could be paid to the owner through a dividend, or the money could then be listed as an asset on his balance sheet, or that money could be used to pay off his debts, which would lower the liabilities on the balance sheet. So if you were just looking at the income statement or the balance sheet, which is how you would be viewing this before 1987, you would have to see the money flowing in of the income statement, and where that money was going out would be whether the asset were becoming a higher value, where the liabilities were decreasing. You would have to basically guess or surmise how that money was being employed based off of how the balance sheet changed from month to month. So what the cash flow statement does is it shows you where that money being generated and where it's being spent and employed throughout the company. So that's where the cash flow statement comes in, and that's going to be its purpose. So let me give another example. Let's go back and let's say that $1,000 flows into John's coffee shop today. Let's say that $1,000 comes into John's coffee shop through the sale of his product, coffee product. Okay, once that $1,000 reaches his corporate bank account, there is a lot of things he can do with that money, a lot more than what you know, the basic things that I have already described. So not only can he have money flowing in from that product that he has produced, that $1,000 from the coffee sale, but then let's just say that this is a public traded company. Now John could actually raise revenue for his company through the issuance of stock. So let's say there is 1,000 shares outstanding in John's coffee shop. Let's say John wanted to issue another 1,000 shares. So there will be 2,000 shares outstanding. When he sells those shares, that's going to bring in an additional revenues, additional funds and cash into his business. So instead of just making $1,000 from the coffee by selling the coffee, he might make another $1,000 just through the sale of his stock. Another way John can raise money is through issue of bonds. But that's not something that you're really going to capture on the income statement. You are just going to see that he has more cash on hand, or whatever the case would be, of the balance sheet, and you would not really understand how it got there first of all. And the cash flow statement helps to identify that gap. So let's just say John issued $1,000 worth of bonds. So he collects $1,000 from some investor in addition to the $1,000 he is already making from his product by selling the coffee. So there is an additional $2,000 that are going on to his balance sheet. Now here is another thing a lot of people might not consider. Let's say John has been using money in his account to purchase public trade companies just like you are doing inside of his corporate account. Now this would kind of make John's coffee shop a holding company, but let's just assume that he owns some shares of a company inside of his corporate account, okay? And those companies he owns inside of John's coffee shop corporate account are making dividends payments to him. So that would be additional income that would not be listed on the income statement. That would only be captured off of the cash flow statement. So those are just few of the different income streams that would be coming into John's coffee shop that are not going to be listed on that income statement, but need to be captured somehow, and that's where you are going to find the cash flow statement very useful. Now, just as we described the funds that were coming into John's corporate account that were not captured off the income statement, there is also funds that are flowing out of John's coffee shop that have not been properly accounted for. Let's go ahead and describe some of those. So the first one that's pretty obvious is if John is paying a dividend to the owners of his company, which would be he himself, if he is paying himself a dividend that's not captured on the income statement. So that dividend payment has to be captured somewhere, and that dividend payment is captured on the cash flow statement that you can see the funds flow out of the company. Let's say that $1,000 that flowed into John's company, let's say he's taking a portion of that $1,000, let's say $250, and he is reinvesting that back into the inventory, or he is using the $250 to upgrade his facilities or his equipment. That's all going to be captured on the investing portion of that cash flow statement. Another thing that you are going to find on the cash flow statement is that the money that John is using to pay off his debts or to make payments on his coupons for the bonds that he might have issued. When you are just working with an income statement and a balance sheet without a cash flow statement, you would see that maybe the liabilities would decrease, but you would not know how much of John's cash was being allocated towards paying off those debts. But now with the cash flow statement, you can now see how much money he is using to pay off his debts and how much money he might be using to retire stock. Let's say before he was raising money by selling stock. Now let's say he's buying 1,000 shares back. Let's say out of 2,000 shares outstanding, he's using $1,000 in order to buy back 1,000 shares back to his business, because that increases the value of the shares that he is holding. So that would be the incentive for him to do something like that. So all of these things, all of these nuances that I am describing here are all captured in this very important document called cash flow statement. So when we open up a cash flow statement and we look at it, the cash flow statement is broken down into three categories. The first category is operating activities, and the operating activities are all those funds that are flowing into the business. So if he was receiving dividend payments from the companies that he owns inside of his corporation, that would be listed on the operating activities. And then the net income is the first thing listed on the operating activities, which comes straight off the income statement. So all that money that's being generated, in other words, business that he is doing, that he is producing, listed there on the operating activities. Now the next one is the second one here is investing activity. So the money that he is using inside of his corporate account in order to buy more supplies, in order to upgrade his facilities, in order to buy new buildings, in order to buy bonds, all those investing type activities are the second item that's listed on the cash flow statement. And then the third item that's listed on the cash flow statement is financing activities. So when I was talking about how he may be issuing more shares, that's a way of financing and raising money for his business. A lot of people might not do it that way, but that's exactly what's happening whenever a company issues more shares. The other way that a company finances is that they issue bonds. So you could either take out a loan or you could issue bonds, and that will raise money, and that's the third category listed on the cash flow statement, and that is the financing activities. So the important number to watch out of those three categories on the cash flow statement is really that operating activity, because this is where you should see the green on the sheet. When you see a positive number under the operating activities, that's the true number that is providing lifeblood of the company. If you see a positive number under investing activities, that actually means he sold some of his investments, and that is the positive cash flow. And same goes for the financing activities. If you see a positive number on the third category in the financing activities, that actually means that he has sold bonds and he has incurred debt. So that's not a good thing. So when you look at the cash flow statement, you want to see the operating activities as a positive number, hopefully a large positive number, and then the investing and the financing activities as the negative number, because he is either buying investment or he is paying off debt. Okay, the first one needs to be positive and the second two needs to be negative. So let's just go through a generic example here. We're going to call this company X, and this is going to be the cash flow statement for the company X. As you can see from the right to the left, I have years 2021, 22 and 2023. The first line is the operating activity, and the next line is the investing activity, and then the third line is the financing activity. And you will see that the fourth line is just the change. If you summed up all the three of those categories, the sum is at the bottom. So let's start with year 2021 and work our way across the operating activities. So in 2021, you can see a company A generated $10,000 in operating activities. The next year it was $11,000, and in the third year it was $12,000. So you see a nice steady growth, and it's all positive number like what we wanted to see, because this is the money what the business does. This is what is producing the income. So it is, if it is a coffee store, the coffee consumption is the primary thing that's generating the operational activities income. Now, as we move down to the next line and we look at the investing activities, you will see that they are all negative. And like I said before, this is a good thing, because this means that he's taking $5,000 in 2021. He is going to take that $5,000 off of that $10,000 that his company produced, and he is taking that $5,000 and he is investing it. He is either investing it into a new coffee product, a new building for his coffee shop, or maybe or on buying $5,000 of stock in another business. That could be any of those things, or maybe he's buying bonds for $5,000 worth and is going to be collecting coupons from that investment. It could be any of those things. Now, if you see a positive number on that line, that would mean that he sold his stock, or he sold his bonds, or he sold half of his plant to some other company that is now producing coffee. But now he does not have that capability to generate that cash flow for the next year. So you would expect, if the investing activities were a positive number, depending on whether it was a good asset or a bad asset, you would be expecting operating activities to go down the following quarter. For the following year, if there is an investing activities are positive number. So you can see in this scenario here, his investing also increased. He keeps investing a large sum as he kept making more money under the operating activities. Now, as we look at the third line, which is the financing activities, it is also a negative number. It's $4,000, $5,000, and then $6,000. This is also a good thing, because this means company A is paying off its debt. In 2021, it paid off $4,000 of its debt, and it had $1,000 remaining after that year. Then as you look at 2022, they paid off another $5,000 of the debt. That's good. If this number was a positive, that means the company would be taking on debt. Now, they would have more cash in their bank account to do whatever they need to do. But in the long run, that company has to pay off the debt. And you are going to see that being set out of the operational activities. and you are not going to have that positive cash flow potentially in the future depending on how they use that capital that they borrowed that year. So this is what you are really looking for. This is a good example of a cash flow statement. You want first operating activities to be positive, and you want the investing activities and the financing activities to be in the negative, and then your net changes needs to be generally be a constant and consistent theme across the board. The fact that the net change in cash is zero in 2023 really does not mean all that much to me, because at that point that the company has a very positive operating activities, are using that money to invest, and they are paying off their debt. So for me, all has a good sign. Now, let's say the company needed a lot of cash in order to conduct an acquisition of another business or another company or something like that. You would see that the company starts stockpiling their cash, and you would see that the net change in the cash be a positive number quarter after quarter as they prepare for that acquisition. That's usually a good sign. If you see a company kind of stockpiling money, you probably know that they are getting ready to conduct an acquisition of another business. In the company X, I was showing you a good cash flow statement. Now let's look at the company Y here. I'm going to show you one that's not looking so good. So let's start from right to left and look at the operating activities. And you can see the operating activities cash flow is slowly decreasing. It's going from 5,000 in 2023 to 4,500 to 4,000. That's bad, because this means that the income, the lifeblood of this company is slowly decreasing. As you know, the equity growth of the business, and there is dividend payments which we are using to value the company. In the long haul, it has to be consistent and it has to be slowly growing in order for them to continue making those dividend payments and for them to continue growing their book value and their equity. So a company like this would have a hard time meeting that, because their earnings and their overall operating activities are decreasing with time. So when we move down to the next line and we look at the investing activities, you can see that the investing activities are also slowly decreasing. Now from 2022 to 2023, it went up by $500, but generally speaking, went from $6,000 to $3,000 to $3,500. And the reason that those investing activities are going down is because the operating activities are going down. They can continue to invest at the same level that they were investing before when they don't have the funds to do it. So now let's get on to the third line and look at the financing activities. You can see that these are positive numbers. So instead of the company paying off debt, it's actually incurring another $5,000 of debt, and in 2022 it's incurring another $3,000 of debt, and 2023 does not look good at all. They took out another $6,000 in debt. That's they're putting money in their bank account and they are borrowing from somewhere somehow. Either they are making that money from issuing more shares, or they are issuing more bonds, or they are taking out loans. But that is not what you want to see. You want to see the first line to be positive and the next two lines to be negative. And you can see that the net change in the cash was 6,500 in 2023, and then 4,500, and then 4,000 in 2021. So even though the net change in the cash was a lot higher here in company Y when compared to company X, but in my opinion, this is a much worse company looking at the cash flow statement because of the trends and the direction that the company and the money is flowing. Here is a summary. Company A, you can see how I have the first line in green and the second two lines in red, and this is what we are looking for. We are looking for that operating activity to be really generating that net change in cash flow. So this concludes the day 24. What is a cash flow statement? And in this chapter we learned what a cash flow statement is, and we also learned how to use the cash flow statement to identify strong companies versus risky companies. So I will see you in the next lesson where we actually apply the cash flow statement to a real business.